P is probably the most important valuation metric in stocks, and it's simple. Let's use a quick story to easily comprehend it. Imagine that you're interested to buy a small cafe to start your first business. You find a cafe that after all expenses it generates 10,000 of net profit per year. How much could you give to buy it? Think a little. The owner sells it for 180,000 pounds. Would you give this amount? Probably not, because 180,000 pounds is 18 times the 10,000 pounds net profit. So if earnings stay the same, it will take you 18 years to get your money back, which is not that good. In the following days, you are negotiating the price and the cafe owner is coming up with lower and lower prices. In the end, he is tired of you. The reason that he wants to sell his business is that he wants to retire and enjoy his life in Bahamas. So he makes this incredible offer, this last offer of 70,000 pounds. Just 70,000 pounds to buy this business that generates 10,000 net income per year. So if earnings stay the same, it will take you just 7 years to get your money back. This sounds like a bargain. So those 7 times is the P. P is how many times the annual earnings you pay to acquire the company. If you had given the initial amount of 180,000 pounds, P would have been 18. If you had given 120,000 pounds, P would have been 12. When price goes up, P goes up. When price goes down, P goes down. The calculation is very simple. P equals price divided by earnings. In our case, 70,000 pounds we pay, divided by 10,000 pounds of annual profit equals 7. P equals 7. We pay 7 times the annual earnings to acquire the business. The logic is exactly the same for a public company that trades in the stock market. Let's take as an example the BT Group. The BT Group has annual earnings of about 2 billion. And the price of the stock, if we go and check, is £1, around £1 and 50p. But how can we use that? We have annual earnings of around 2 billion and then a price per share of £1 and 50p. When we buy a share, we buy just a tiny fraction of the whole company. We become owners of a very small fraction. The BT Group has 10 billion shares. When we buy one share, we buy one part in 10 billion. If we want to become owners of the whole business, we have to buy every single share. So what we have to give is £1 50p multiplied by 10 billion shares. That equals around 15 billion pounds. We have to give 15 billions to acquire the whole company. Those 15 billions is the market capitalization or market value. So now we can do the calculation. We have the price and the earnings. P equals price divided by earnings. The price is around 15 billion, the earnings are around 2 billion. So 15 billion divided by 2 billion, the P equals around 7. We pay around 7 times the annual earnings to buy the BT Group. Is that a bargain? I believe that the BT Group is bargain. Generally speaking, a lower P means a lower price and a cheaper stock. Statistically, if we buy stocks with low P, we will have better investing returns than buying expensive stocks. However, the difference is not that huge because many times stocks are cheap for a reason. Let's think, for example, that in the cafe that we were interested to buy, the owner was not selling it because he wanted to retire and enjoy his life in Bahamas, but because he knew that Starbucks were opening a few meters away, and he knew that he would lose half of its customers and his cafe would be loss making. The purpose of this video is not to tell you that low P is a bargain and high P is expensive. The purpose of this video is to help you comprehend the metric and make you think as an owner. When you buy stocks, you become an owner, so you have to be sensitive about the price you pay. Price is what you pay, earnings is what you get. That's why I like P. I like the logic behind this simple function. Otherwise, P is so simplified that very often fails. In the next video, I will talk to you about some cases that P fails. So subscribe to receive a notification. See you.